The Beginner's Guide to the Income Statement. The income statement is one of the most important financial statements, and it tells a story about a company's financial performance over a specific period of time. The income statement is a key tool for assessing a company's profitability, growth, and overall financial health. Most commonly, income statements are presented as a monthly, quarterly, or yearly statement. There's also the balance sheet and cash flow statement, which are also important, but we have separate videos for those, which you can find in the description or the corners or whatever. So here we'll take a look at a simple example of how it works and how to analyze it. The presentation of an income statement can vary quite a bit, but generally speaking, it'll list out several components and provide a detailed breakdown of a company's financial performance. In its simplest format, it'll usually consist of revenue, cost of goods sold, gross profit, operating expenses, and your net income. Understanding how these components work and how to analyze them is essential for you to be able to determine how your company is performing and how to make informed decisions for the future. So as with most things, it's easier to learn when looking at an example. So let's review the income statement for an imaginary company called a beer co. No relation. So at the top, you have everybody's favorite number, revenue. Revenue is always listed at the top and consists of all the money earned from normal operations. What I mean by normal operations is that it doesn't include these one-off things like selling a building that you had bought at a profit if that's not your main course of business. Revenue is usually generated from the sale of products or services. However, for some companies, it comes from things like rent or investment income. Now, so far that sounds pretty simple, but revenue can be broken down in a couple of different ways. For example, sometimes it can be presented as $1 million of gross revenue less $200,000 of discounts. Or it can just be presented as $800,000 of net revenue. You can also break up revenue by channel, for example, wholesale revenue versus e-commerce revenue. Now, if you're preparing your income statement for external users, you may have to do so in accordance with the Generally Accepted Accounting Principles, or GAAP. They'll have specific rules about how things should look and how they should be recorded, and that can vary from one jurisdiction to the next. But if you're preparing an income statement for internal use, then you can do whatever you want. The point is that it's a tool to help you make better decisions. Usually this revenue number is pretty straightforward. For example, somebody bought $100,000 of drones from me and I shipped them the drones, so I've earned the revenue. But say I have a $50 million construction contract and I'm 20% of the way through that contract. You could have said that you earned $10 million of the revenue, but it can get a little more complex than that based on the stipulations in the contract. But that's where accounting can get a lot more complicated, so that's not what we're going to cover here. So let's move on to the next item on the list, which is your cost of goods sold, or COGS for the cool kids. The cost of goods sold is the direct cost associated with earning that revenue. So in our example, a beer co is making the big bucks and has earned a cool $1 million over the past year. For the sake of simplicity, let's just say that if you sold 1,000 units of something, your COGS would be 1,000 units times your cost per unit. Calculating the cost per unit correctly can be a little bit complicated, but again, beyond the scope of this video. There are also multiple ways to calculate COGS, like first in, first out, FIFO, last in, first out, LIFO, average weighted cost, or the retail method. But for now, let's just keep it simple and say that to earn that $1 million of revenue, I had to ship goods that had cost me $500,000. That leads us to the next item, which is your gross profit. Your gross profit is calculated as your revenue less your COGS. This is a very important number to pay attention to because your gross profit is basically the money generated from the business conducting its main activity, which is selling stuff. A related number that's very important to pay attention to is your gross profit margin. That's simply your gross profit divided by your revenue presented as a percentage. The higher this percentage, the better, because it means that for each additional dollar of revenue, more of that flows down to your profit. So in our example, we had a revenue of $1 million less COGS of $500,000, which gives us a gross profit of $500,000, or a gross profit margin of 50%. Next up, you've got your operating expenses. These are all the expenses that are related to just running your business, and not the ones related to what you had to do to earn the revenue. These expenses include things like salaries, rent, software, marketing, etc. You deduct your operating expenses from your gross profit to get to your operating income. You can break up these operating expenses into as much detail as you need. It can be 20 lines or just 2. It comes down to what's actually helpful to make decisions. So for a beer co, we'll deduct $200,000 of administrative expenses and $100,000 of research and development expenses, and that'll give us a total operating expenses of $300K. We deduct that from our gross profit to arrive to an operating income of $200K. The operating income number is a very important one because it gives you an idea of how much profit a business is generating from its core activities. Now this covers the majority of the stuff on the income statement, but there are a couple of other stops to visit before we finish. Beyond your operating income, you'll have your other income and expenses. These are things that are generally not related to your main operations. So to explain with some examples, let's say a beer co had interest income of $10,000 because it had some money invested somewhere. It also had a gain of $20,000 from selling a building. And similarly, it had an interest expense on loans of $15,000 and a small loss of $5,000 from selling some machinery. All of these incomes and expenses are more related to investing and financing activities, so not really part of the core business. So when we add all of that up with our operating profit, we get to our net income before taxes of $210,000. The next item is to deduct your tax expense. I probably don't have to explain what taxes are. So a beer co is going to deduct a $50,000 tax expense, which will bring us to our net income of $160,000. This is the bottom line of the income statement, and it is a strong indicator of the business's profitability. So now that we know what our income statement looks like and what it consists of, how do we actually analyze all this information? There are a lot of ways to interpret the data on an income statement, but a couple of fan favorites are horizontal analysis, vertical analysis, and ratio analysis. So let's look at horizontal analysis first. This method will look at the income statement over several periods side by side, or horizontally. This allows you to analyze the percentage change in various income statement items from one period to the next, and it can also allow you to look at trends over larger periods of time. So for example, if a beer co had $1 million of revenue in year 1 and $1.2 million in year 2, you'll see that there's a 20% increase. And if you laid out 10 years side by side, you could identify what sort of growth rate the company is trending towards. Now, if all the lines on the income statement are growing at the exact same rate as revenue, then things will seem stable. But if your revenue is growing at 20% and your gross profit is growing at only 5%, that could be a worrying trend to see. Maybe the revenue growth is coming with too many discounts, or maybe your cost per unit is going up. Looking at trends in this way is especially helpful if you want to be able to extrapolate out to forecast future performance. Now, let's take a look at vertical analysis. Vertical analysis looks at each line item on the income statement and expresses it as a percentage of revenue. Whether these percentages are good or bad will be a function of your business model. For example, if you have a lot of retail locations, then maybe it makes sense for rent to be 20% of your revenue. But if you run a marketing agency, then it should probably be a lot lower. So looking at a beer co, our cost of goods sold was 50% of total revenue. And our research and development expense was 10% of total revenue. That means that for every dollar of revenue earned, 10 cents of it was spent on research and development. You can combine horizontal and vertical analysis to be able to see the trends over time of the percentages of revenue. So I might have a gross profit margin of 50% in year 1, but I would hope that as my purchase volume goes up, my cost per unit will come down, and so my gross profit margin will go from 50% to maybe 60%. Looking at how that number changes over time is especially helpful if you're going to try to forecast future performance. Lastly, we'll look at ratio analysis. Ratio analysis is kind of similar to vertical analysis, except that it's not solely focused on revenue. So for example, if you run a brick and mortar business, you might look at a ratio like your gross profit divided by your rent. That can give you an indication of how much money you're generating for the amount of locations that you have. Ratios can also be done by combining the financial statements. So for example, looking at your operating income divided by the debt that's going to come due in the next 12 months. Ratios don't tell the whole story, but if you pick the right ones, they can be very helpful in understanding your financial performance. So as you can see, the income statement is a very powerful tool and valuable for a number of reasons. Firstly, it gives you insights into historical performance, and that data can be sliced and diced to better understand what you can do to make improvements. Secondly, you can look at historical trends and combine that with certain assumptions about the future, as well as strategic decisions, to be able to plan out future performance. Thirdly, it's a great way to report on financial performance to other parties, like owners, investors, and lenders. But while the income statement is a very valuable tool, it does have some limitations. For one, the income statement is usually prepared using the accrual method of accounting. If you want to understand what the accrual versus cash methods of accounting are, you can check out the videos in the description in the corners. The limitation of this is that it means that you need the balance sheet and the cash flow statement to really get a complete picture of what's going on. A company can seem super profitable according to the income statement, but they could also be bleeding cash at the same time. And if you run out of cash, you're done for. On the flip side, a company's income statement may make it seem like they're not very profitable, but they're just making investments into the future. For example, they may have a high research and development expense, which is bringing their profits down. But that could lead to huge growth once the research pans out. So the takeaway is that while the income statement is a very important financial statement, there's a lot more depth to be able to understand a company's performance holistically. So thank you for watching this beginner's guide to the income statement. And since you made it this far, you may as well just like, share, subscribe, and click all the magic buttons. And with that said, for now, take care.